Right now, Semrush is trading at exactly $11.79 per share, exploding upwards by an incredible 5.03 points, or 74.41% on the intraday charts. If you're looking at your screen wondering if there is a glitch in the matrix or if a decimal point got moved by accident, let me assure you, this is real, and the volume backing this move is nothing short of astronomical. We are seeing over 32 million shares exchange hands in a session where the average is usually closer to 1 million. This is not just a breakout. This is a fundamental liquidity event that completely rewrites the thesis for this company. Most retail traders woke up this morning expecting another standard day of chop in the mid-cap SaaS sector, perhaps worrying about interest rates or general tech volatility. The expectation was that Semrush would continue its slow grind as a standalone entity, fighting for market share in the competitive SEO data landscape. The reality, however, has smashed that expectation into pieces. The reality is that Semrush has effectively been taken off the board. The massive green candle you are seeing is the result of a definitive acquisition announcement. Adobe has agreed to acquire Semrush for $12 per share in an all-cash deal valued at approximately $1.9 billion. This is the moment where the rubber meets the road for every investor who held through the volatility of the last 2 years. When you look at a move of this magnitude, the immediate reaction is often euphoria, followed by a scramble to understand the mechanics. Why $12? Why now? And more importantly, why is the stock trading at $11.79 and not exactly $12? That tiny gap, that 21-cent spread, is where the real story of market psychology lives today. It represents the minuscule yet present risk that regulators might step in or that the deal could face hurdles. But for all intents and purposes, the market is pricing this as a done deal. If you are holding Tesla stock or watching the wild swings in NVIDIA stock, you are used to volatility based on sentiment and future earnings projections. This is different. This is merger arbitrage in real time. The price you see now is effectively the cash value of the payout Adobe has promised, discounted only by the time value of money and that sliver of closing risk. For those of you managing your own capital through an individual brokerage, seeing a portfolio holding jump 74% in a single pre-market session is the kind of event that validates months of patience. It forces us to re-examine the entire software landscape. We often think of these tools as niche utilities, but Adobe's move signals that data visibility, knowing what people search for and why, is becoming a critical infrastructure layer for the AI economy. Let's analyze the price action leading up to this because it tells a fascinating story of accumulation and capitulation. Before this news dropped, Semrush was lingering around the $6.76 mark, a valuation that many value investors argued was too low given their recurring revenue, but one that the broader market ignored because it wasn't AI enough. The irony, of course, is that Adobe is buying them precisely because they are the missing piece of the AI puzzle. If you look at the chart from last week, you saw low volatility, low volume, and a general disinterest from the heavy hitters. Then, boom! The gap up today didn't give anyone a chance to buy the dip. If you were waiting for a better entry price on your Robinhood app or setting limit orders on your Fidelity mobile app, you were left behind. This is a classic gap-and-go scenario driven by a buyout, which is the ultimate short squeeze, because the shorts have no thesis left. They cannot argue valuation anymore, because the valuation has been set in stone by a buyer with deep pockets. The short interest, which had been creeping up as skeptics bet against the SEO industry's relevance in a world of ChatGPT, has been incinerated. Those buy orders you see flooding the tape at $11.78 and $11.79 are likely a mix of shorts covering in panic and arbitrage funds stepping in to capture that final 1% spread before the deal closes. It is crucial to understand the broader context of why this is happening. The expectation for companies like Semrush was that large language models would destroy their business model. The logic went like this: if everyone uses AI to find answers, nobody will search on Google, so nobody will need SEO tools, and Semrush will go to zero. That was the bearish thesis. The reality, which Adobe just validated with a $1.9 billion check, is that in an AI-generated world, owning the data on what people are interested in is more valuable, not less. Adobe isn't buying a keyword tool. They are buying a massive proprietary dataset of consumer intent. They are buying the ability to tell their Creative Cloud users not just how to design an image, but what images the world is actually searching for right now. This effectively transforms Semrush from a marketing utility into a generative AI intelligence engine. This is the angle that the retail crowd on SoFi Invest forums missed, but the institutional strategists at places that manage Fidelity wealth management accounts likely suspected. The consolidation of data owners is the new trend. We saw it when Cisco bought Splunk, and we are seeing it here on a smaller but strategically vital scale. Let's shift gears to the financials that supported this valuation, because Adobe didn't just pick a number out of a hat. In their most recent quarterly report, Semrush posted revenue of $112.1 million, which was a 15% increase year over year. That is solid, double-digit growth in a tough macro environment. But the number that likely sealed the deal for Adobe was the annual recurring revenue, or ARR, which hit $455 million. When you do the math, Adobe is paying roughly 4 times ARR for Semrush. In the heady days of 2021, SaaS companies were trading at 20 or 30 times revenue. Today, paying 4 times is considered a fair, perhaps even disciplined price. However, some long-term shareholders might feel this exit is premature. There is already chatter among legal firms like Helper SDA EH investigating whether 12 is fair or if shareholders are being shortchanged just as the company was pivoting to profitability. This adds a layer of tension. If you are holding shares, you have to decide, do you sell now at $11.79 and take the massive win, or do you hold and hope for a shareholder revolt that demands $14 or $15? It's a classic dilemma. If you use interactive brokers trading platforms, you might check the options chain to see if traders are betting on a higher bid, but right now, the market seems to accept $12 as the ceiling. The operational efficiency Semrush displayed in the last few quarters paved the way for this merger. They weren't just burning cash to grow at all costs anymore. They showed they could generate cash from operations, $21.9 million in the last quarter alone. That cash flow positivity is what makes a company an attractive target. A buyer like Adobe doesn't want to inherit a money pit. They want a machine that can be plugged into their ecosystem and immediately start contributing to the bottom line. Semrush's client base is another massive asset. We are talking about enterprise giants like Amazon, Tesla, and massive agencies that rely on this data daily. Transitioning these customers to the Adobe ecosystem creates a sticky environment that is very hard to leave. It's the same strategy we see with Schwab Intelligent Portfolios or Fidelity Mutual Funds. Once you are in the ecosystem, the friction to leave is high, and the lifetime value of the customer goes up. Adobe knows that if they can integrate Semrush's SEO data into their analytics and content creation workflows, they create a loop where marketers create content, optimize it with Semrush data, and measure it with Adobe Analytics, all without ever leaving the Adobe interface. I want to pause here and get a pulse on where you stand with this merger news. Comment below how many shares of Semrush you currently hold, and tell me, are you happy taking the $12 cash buyout, or do you feel the management sold out too early just as the AI wave was starting? I read every comment, and I am genuinely curious if the retail sentiment matches the institutional enthusiasm we're seeing on the charts. Now let's talk about the risks that remain, because even with a definitive agreement, the market is never without risk. The primary hurdle here is regulatory approval. We are in a climate where big tech acquisitions are scrutinized heavily. Adobe already had to walk away from its acquisition of Figma due to regulatory pressure. While Semrush is a smaller fish and operates in a slightly different vertical than Adobe, regulators could argue that consolidating too much marketing data under one roof is anti-competitive. If the deal falls through, if the FTC or European regulators block it, Semrush stock would likely plummet back to the $7 or $8 range. That is the deal break risk. That is why the stock is trading at $11.79 and not exactly $12. That 1.7% discount is the market's pricing of that regulatory anxiety. For conservative investors using Fidelity IRAs or seeking stable investment help, holding through this closing period might not be worth the stress for a measly 1% gain. But for our